In this video, we will discuss about the scope of financial management and the functions of financial manager. Financial management provides a conceptual and analytical framework for financial decision making. The finance function covers both acquisition of funds as well as their allocation. Thus, apart from the issue involved in acquiring external funds, the main concern of financial management is the efficient and wise allocation of funds to various uses. Defined in a broad sense, it is viewed as an integral part of overall management. The financial management framework is an analytical way of viewing the financial problems of a firm. The main contents of this approach are: what is the total volume of funds an enterprise should commit? What specific assets should an enterprise acquire? How should the funds required to be financed? Alternatively, the principal contents of the modern approach to financial management can be said to be: how large should an enterprise should be, and how fast should it grow? In what form should it hold assets, and what should be the composition of its liabilities? The three questions posed above cover between them the major financial problems of a firm. That is, the financial management according to the new approach is concerned with solution of three major problems relating to the financial operations of a firm, corresponding to the three questions of investment, financing, and dividend decisions. Thus, financial management in the modern sense of the firm can be broken down into three major decisions as functions of finance: the investment decision, the financing decision, and the dividend policy decision. What do you mean by investment decision? Investment decisions relates to the selection of assets in which funds will be invested by a firm. The assets which can be acquired fall into two broad groups: long-term assets which yields a return over a period of time in future, and short-term or current assets defined as those assets which in the normal course of business are convertible into cash without diminution in value, usually within a year. The first of these, involving the first category of assets, is popularly known in financial literature as capital budgeting. The aspect of financial decision making with reference to current assets or short term assets is popularly termed as working capital management. So, friends, what is capital budgeting? See, capital budgeting is probably the most crucial financial decision of a firm. It relates to the selection of an asset or investment proposal or course of action whose benefits are likely to be available in future over the lifetime of the project. The long-term assets can be either new or old or existing ones. The first aspect of capital budgeting decision relates to the choice of the new asset out of the alternatives available, or the reallocation of capital when an existing asset fails to justify the funds committed. Whether an asset will be accepted or not will depend upon the relative benefits and returns associated with it. The measurement of the worth of the investment proposals is therefore a major element in the capital budgeting exercise. This implies a discussion of the methods of appraising investment proposals. The second element of the capital budgeting decision is the analysis of risk and uncertainty, since the benefits from the investment proposal extend to a large period of time in future and their accrual is uncertain. Therefore, they have to be estimated under various assumptions of the physical volume of sale and the level of price. An element of risk in the sense of uncertainty of future benefits is thus involved in the exercise. The returns from capital budgeting decisions should therefore be evaluated in relation to the risk associated with it. And finally, the evaluation of the project of a long-term project implies a certain norm or standard against which the benefits are to be judged. The requisite norm is known in different names like cutoff rate, hurdle rate, required rate, minimum rate of return, and so on. This standard is broadly expressed in terms of the cost of capital. The concept and measurement of the cost of capital is thus another major aspect of capital budgeting decision. The main elements of capital budgeting decisions are the long-term assets and their composition, the business risk complexity, and the concept of measurement of the cost of capital. Working capital management is concerned with the management of current assets. It is an important and integral part of financial management as short-term survival is a prerequisite. For long-term success, one aspect of working capital management is the trade-off between profitability and risk. There is a conflict between profitability and liquidity. If a firm does not have adequate working capital, it does not invest sufficient funds in current assets. It may become illiquid and consequently may not have the ability to meet the current obligations and thus invite the risk or bankruptcy. If the current assets are too large, profitability is adversely affected. The key strategies and considerations in ensuring a trade-off between the profitability and liquidity is one major dimension of working capital management. In addition, the individual current assets should be efficiently managed so that neither inadequate nor unnecessary funds are locked up. Thus, the management of working capital has two basic ingredients: an overview of working capital management as a whole and efficient management of the individual current assets such as cash receivables and inventory. Coming to the financial decision, which is also one of the major aspects of the financial management, it is the financing decision. The investment decision is concerned with the asset mix or the composition of the assets of a firm. The concern of financing decision is with financing mix or capital structure or the leverage. The term capital structure means what? It is the proportion of debt, that is the fixed interest source of financing, and equity capital, which is the variable source of funds. The financing decision of a firm relates to the choice of the proportion of these sources to finance the investment requirements. There are two aspects of the financing decision. First is the theory of capital structure, which shows the theoretical relationship between the employment of debt and the return of the shareholders. The use of debt implies a higher return to the shareholders as also the return to the shareholders. The use of debt implies a higher return to the shareholders as also the financial risk. A proper balance between debt and equity to ensure a trade-off between risk and return to the shareholders is thus necessary. A capital structure with a reasonable proportion of debt and equity capital, it is called as the optimum capital structure. Thus, one dimension of the financing decision whether there is an optimum capital structure and in what proportion should funds be raised to maximize the return to the shareholders. The second aspect of financing decision is the determination of an appropriate capital structure given the facts of a particular case. Thus, the financing decision covered two interrelated aspects. the capital structure theory, and the capital structure decision. So, the third major decision area of financial management is the decision relating to the dividend policy. The dividend decision should be analyzed in relation to the financing decision of a firm. Two alternatives are available in dealing with the profits of a firm. They can be distributed to the shareholders in the form of dividends, or they can be retained in the form in the business itself. The decision as to which course should be followed depends largely on a significant element in the dividend decision, the dividend payout ratio, that is, what proportion of net profit should be paid out to the shareholders. The final decision will depend upon the preference of the shareholder and investment opportunities available within the firm. The second main aspect of the dividend decision is the factors determining the dividend policy of a firm in practice. So, to conclude, the traditional approach to the functions of financial management or the financial manager has had a very narrow perception and was devoid of an integrated conceptual and analytical framework. It had rightly been discarded in the academic literature. The modern approach to the scope of financial management has broadened its scope, which involve the solution of three major decisions: investment, financing, and the dividend decisions. These are interrelated and should be jointly taken so that financial decision making will become optimal. The conceptual framework for optimum financial decisions is the objectives of financial management. That is, to ensure an optimum decision in respect to these three areas, they should be related to the objectives of financial management. The objectives of the financial management is very important for a long term success in a business organization. So friends, now we will move on to the discussion of the functions of a financial manager. The primary activities of a financial manager are performing financial analysis and planning and making investment decisions, and also making financial decisions. So, what kind of financial analysis and planning does a financial manager do? The concern of financial analysis and planning is within transforming financial data into a form that can be used to monitor financial condition, evaluating the need for increased or reduced productive capacity, and determining the additional or reduced financing required. Although this activity relies heavily on accrual based financial statements, its underlying objective is to assess cash flows and develop plans to ensure adequate cash flows to support achieving the firm's goals. In making investment decisions, as investment decisions determine both the mix and the type of assets held by a firm, where the mix refers to the amount of current assets and fixed assets. Consistent with the mix, the financial manager must determine and maintain certain optimal levels of each type of current assets. He should also decide the best fixed assets to acquire and when existing fixed assets need to be modified or replaced or to be liquidated. The success of a firm in achieving the goals depends on these decisions. And finally, the financing decisions involve two major areas: most appropriate mix of short term and long term financing, and the second, the best individual short term or long term sources of financing at a given point of time. Many of these decisions are directed by necessary, but some require an in depth analysis of the available financing alternatives, their costs, and their long term implications. So, friends, it is very important for a financial manager to be very careful in performing and making such kind of financing, investing, and dividend decisions. Friends, apart from making the decisions of investing, dividend decisions, and the financing decisions, reflecting the emerging economic and financial environment in the post liberalization era, the job of financial managers in India has become more important, complex, and demanding. Some of the key challenges in the areas specified below by the financial manager are the financial structure, the foreign exchange management, treasury operations, investor communication, management control, and investment planning. The main elements of the changed economic and financial environment are: there is a considerable relaxation in industrial licensing framework in terms of the modifications in the Industries Development Regulations Act, abolition of the Monopolies and Restrictive and Trade Practices Act and its replacement by the Competition Act, repeal of Foreign Exchange Regulations Act and enactment of a liberalized Foreign Exchange Management Act, abolition of Capital Issues Act, and the setting up of the Securities and Exchange Board of India under the SEBI Act for the regulation and development of the securities market and the protection of investors, enactment of the Insurance Regulatory and Development Authority, that is IRDA Act, and the setting up of the IRDA for the regulation of the insurance sector and the consequent di- dismantling of the monopoly of LIC and GIC and its subsidiaries. Emergence of the capital market at the center stage of the financing system and the disappearance of the erstwhile development public financial term lending institution from the Indian financial sector. Emergence of a highly articulate and sophisticated money market, globalization, convertibility of rupee, liberalized foreign investments in India, Indian foreign investments abroad, market determined interest rate, emergence of highly innovative financial instruments, growth of mutual funds, credit rating, other financial services, and rigorous prudential norms, credit risk management framework for banks and financial institutions, access to euro issue, American depository receipts, and privatization, disinvestment of public sector undertakings. All this has made the role of the managers more complex.